Someone told you there's £1,000 you can earn tax-free from a side hustle. So you did the sensible thing. You added up your profit, saw it was under 1,000 and relaxed. Here is the problem straight away before you file anything wrong. The £1,000 trading allowance is not measured on your profit. It is measured on your total sales. And that difference is the reason a lot of people think they are safely under the line when they are actually over it. Let me show you exactly how this catches people. Say you sold £1,100 of things over the year, candles, prints, a bit of freelance work, whatever it was, and say you spent £300 making it all happen. Materials, postage, fees. So your actual profit is £800. In your head, you are under the 1,000. You are fine. But HMRC does not look at your £800 of profit for this test. It looks at the £1,100 that came in. That is your gross income, your total sales before any costs. And because that number is over 1,000, the allowance no longer just covers you. You now have to tell HMRC about it. So why is it built this way? Because the trading allowance was never designed as a profit threshold. It was designed as a simple, flat relief for very small casual earners. The rule is deliberately blunt. If your total trading income for the year is £1,000 or less, you usually do not need to register or report it at all. It is genuinely tax-free and paperwork-free. But the moment your total sales go £1 over that line, the simple version ends and you are expected to declare it, even if your profit after cost is tiny. Here is the part that actually softens the blow because it sounds worse than it is. Being over the line does not mean you owe tax on the whole £1,100. It means you now have a choice. You can either claim the £1,000 allowance and pay tax only on the rest. Or if your real expenses were higher than 1,000, you can deduct your actual costs instead. You pick whichever leaves you better off. What you cannot do is use both. It is the flat 1,000 or your real expenses, never the two stacked together. Let me say the trap back to you clearly, because this is where the mistake lives. The £1,000 figure is a sales number when you are deciding whether you have to report at all. People treat it as a profit number, decide they're under it, and quietly do nothing. Then a platform like Vinted, Etsy, or eBay reports their sales straight to HMRC. The total is over 1,000. And there is a mismatch between what HMRC can see and what the person declared, which is nothing. That gap is exactly the thing that turns a calm situation into a letter. So what should you actually do? Know your gross number. Not your profit, not your take home, your total sales for the tax year, the 6th of April to the 5th of April. If that number is under 1,000 and it is your only bit of self-employed income, you can usually breathe out. If it is over, you register, you declare, and then you choose the allowance or your expenses. None of that is frightening once you can see the number. The whole problem is that most people never total it up, so they are guessing. And they guess using profit because profit is the number that feels relevant. The JR Former UK Sole Trader Tracker keeps that gross sales figure adding up as you go. So you always know which side of the £1,000 line you are on long before HMRC does. So no, the £1,000 is not about what you kept. It is about what came in. Add up your sales, not your profit. And the rule that quietly catches people becomes a line you can see coming from a mile off.